The last big wealth opportunity before retirement almost never arrives in a clean, respectable package. It arrives disguised as confusion. That is what makes it so easy to miss. A lot of investors think the final meaningful opportunity of a cycle should be obvious. They imagine it will come with a reassuring explanation, a clear trend, broad agreement, and enough emotional comfort that they can act without feeling foolish. That is not how real money gets made late in the game. Real money gets made when three different kinds of opportunity overlap, and the crowd is too distracted by the surface chaos to see the architecture underneath it. That is the setup I care about right now, so let me give you the one mother line that everything in this story serves. The biggest late cycle opportunity appears when temporary forced selling, structural demand shifts, and new innovation capital all line up at the same time. That is the line. Not one trade, not one safe haven, not one headline, a layered overlap. Because when those three layers align, you are no longer looking at a single idea. You are looking at a field of mispricing created by panic at one level, by regime change at another, and by new capital formation at a third. Most investors only know how to look for one kind of opportunity at a time. That is why they keep showing up late. They understand a crash sale, or they understand a long-term theme, or they understand a new technology wave. They rarely understand all three at once. That is where the edge is. Now let me show you the mechanisms. The first mechanism is forced liquidation discount. This is the cleanest form of temporary opportunity in all of markets. When a large actor is forced to sell, price stops being a pure expression of value and starts becoming an expression of urgency. That distinction matters enormously. If a country, a sovereign fund, or a leveraged institution needs dollars immediately, it does not ask whether the current market price is fair. It asks how fast it can convert inventory into usable cash. That is forced liquidation. And forced liquidation creates discounts that have nothing to do with the long-term case for the underlying asset. This is exactly why I care so much about the precious metals setup. If large holders are liquidating gold and silver, not because they lost faith in the metals, but because oil shock, currency defense, or emergency liquidity needs forced their hand, then the decline is not the death of the thesis. It is a markdown caused by stress. That is a very different thing. The public sees lower prices and assumes the market learned something bearish. The prepared investor sees lower prices and asks whether the seller is informed or trapped. That is the whole game. If the seller is trapped, then the lower price may be a gift. This is why temporary dislocations matter so much late in a cycle. The same event that looks scary to passive observers looks attractive to people who understand that forced selling is finite. A sovereign can only dump so much. A panic-driven liquidation ends when the pressure ends, if the long-term structural demand remains intact underneath it. Then the temporary discount is exactly what serious capital waits for. That is forced liquidation discount. Now let us move to the second mechanism. I call it structural substitution. Most people look at a major oil shock and stop at oil. That is a mistake. Oil shocks do not only reprice oil, they reorder the entire energy stack. Once one part of the system becomes expensive enough, another part suddenly becomes economically relevant. Again, that is what substitution means. It is not ideological. It is not clean. It is not pretty. It is simply the market's way of asking what remains available, scalable, and cheap enough to fill part of the gap. That is where coal re-enters the picture. People who still think coal is finished are using a moral map instead of an economic one. I understand the public relations problem. I do not confuse that with the reality of industrial systems. If oil stays elevated and natural gas stress persists, utilities and industrial economies start looking for the cheapest workable alternative. Coal may be socially unfashionable, politically awkward, and underowned by modern capital, but that is exactly why it can become explosive when the market rediscovers that supply was starved while demand did not fully disappear. That is structural substitution. and it is one of the most powerful late-cycle forces because it often appears in sectors nobody wants to brag about owning. Glamour does not drive those returns. Neglect does. Years of underinvestment create constrained supply. Then a new energy regime or a price shock suddenly makes that neglected supply strategically useful. Again, margins expand, inventories get rebuilt. Demand reappears from places that swore they were done with it. That is why this kind of setup can be so violent. The market spends years pretending a sector is uninvestable. Then one macro shock makes that pretense too expensive to maintain. Now let us move to the third mechanism. I call it innovation bid. This is the opposite of forced selling and the opposite of neglected value. Here, the engine is not distress or substitution. It is new money chasing a structural breakthrough, venture money, pharmaceutical money, strategic buyers, large cap acquirers, and platform capital all begin moving toward one category because a change in technology has made old economics obsolete and new economics possible. That is what I see in biotech. Not all biotech, of course, that would be sloppy thinking, but the sector level logic is strong enough that the flow matters. Large pharmaceutical companies are facing a patent cliff that can vaporize revenue streams they have relied on for years. They need replacement assets, they need pipelines, they need molecules, platforms, therapies, and technologies that can become the next generation of protected economic value. At the same time, AI is sharply reducing the cost and time of drug discovery, which means the funnel of potentially valuable targets is getting wider, just as the incentive to buy them is getting stronger. That is innovation bid. And when big strategic capital must acquire because organic replacement is too slow, the smaller names with promising assets or platforms stop being science experiments and start becoming takeover candidates. That changes the whole sector dynamic. This is why the opportunity here is not simply biotech might do well. It is that a sector with historically high failure rates now has three forces lining up behind it. The need from large incumbents, the cost compression from AI-assisted discovery, and the flow of venture and strategic capital searching for the next wave of pipeline replacement. That is far more powerful than a casual growth story. Now let us move to the fourth mechanism. I call it three-layer confluence. Most investors lose money because they treat each opportunity type in isolation. They either hunt bargains or chase structural themes or speculate on innovation. They do not understand what happens when the market offers all three at once. That is three-layer confluence. A forced selling event in precious metals gives you temporary dislocation. A structural energy substitution toward coal gives you a medium-term fundamental shift. An innovation wave in biotech gives you a capital flow and EMA engine. Those are not the same trade. That is precisely why they matter together. When multiple opportunity types are active at once, you do not need one single hero trade to define your next decade. You can build a portfolio around different kinds of edge, one based on temporary discount, one based on macro substitution, one based on innovation and acquisition flow. That is the real institutional way to think, not what is the one stock. What is the type of opportunity? What is the time horizon? What is the driver? What is the failure mode? And how does it fit with the others? That is how serious capital behaves. Now we come to the fifth mechanism. I call it hidden flow. One of the reasons ordinary investors show up late is that they keep waiting for stories to become visible in public before treating them as real. Institutions do not think like that. They watch flows. They watch who is allocating, who is buying inventories, who is issuing mandates, who is deploying venture capital, who is pursuing takeovers, who is stepping into unloved assets before the media narrative catches up. That is hidden flow. The market rarely hands you a neat public explanation before the move begins. In fact, the best setups often look muddled from the outside because the flow is happening underneath before the story is coherent enough for everyone else. That is especially true in sectors the public dislikes, ignores, or mistrusts. Coal does not get a glamorous rollout. Distressed gold selling does not come with a polite explanation that now is a discount. Small biotech targets do not announce that large-cap pharmaceutical capital is about to need them desperately. You have to infer it. That is what makes these windows so valuable. They reward investors who can read changing behavior before the narrative becomes popular. Now let us move to the sixth mechanism. I call it late cycle concentration. The closer you get to the end of a cycle, the less forgiving the market becomes. Broad passive comfort starts losing its edge. Generic exposure becomes more dangerous because the market is no longer lifting all decent assets together. Some parts of the system are under pressure. Some are being repriced, some are being starved, some are being rediscovered. Opportunity narrows and becomes more concentrated. That is late cycle concentration. It does not mean you should become reckless or put everything into three ideas. It means the biggest opportunities stop living in the middle of the market and start living in the corners where forced selling, structural change, and innovation flow have not yet been fully arbitraged away. That is exactly why retirees and near retirees need to pay attention. At this stage of life, you do not get infinite cycles. You do not get endless time to recover from broad market dead years or from passive allocations that drift sideways while inflation and opportunity cost erode what remains. If a concentrated set of asymmetrical windows opens and you ignore them because they feel less comfortable than broad index autopilot, you may miss the final major chance to reshape the trajectory of your retirement capital. That is the real urgency. Not because you need to gamble, because the cycle is getting less generous. Now let us move to the seventh mechanism. I call it structured contrarianism. A lot of people think contrarian investing means buying whatever everybody hates. That is amateurism. Real contrarianism is structured. It asks why the asset is hated, what kind of flow is pushing it down or keeping it ignored, whether that condition is temporary or permanent, and what force is likely to reverse the pricing if the public remains late. That is structured contrarianism. Gold and silver under forced sovereign selling are hated for one reason. Coal under years of political and ESG neglect is hated for another. Biotech after years of volatility and trial failure fatigue is ignored for a third. Those are distinct conditions, and they require distinct sizing, timelines, and expectations. That is why I reject the simplistic slogan that you should just buy what everyone hates. No, you should buy what everyone hates for the wrong reason, or what they are too slow to revalue when a new driver appears. That is the actual discipline. Now I want to force the identity shift, because without it you will keep hearing this as three random trades instead of one coherent framework. Stop thinking like a stock picker. Start thinking like a layer reader. A stock picker asks what ticker to buy. A layer reader asks what kind of opportunity is appearing. Forced liquidation, structural substitution, or innovation flow. A stock picker wants a name. A layer reader wants a mechanism. A stock picker chases stories after they are obvious. A layer reader positions when the flow is there, but the public explanation is still messy. That is the stronger identity, because late cycle wealth is not built by reacting to one lucky headline. It is built by understanding what kind of opportunity the market is currently offering and taking the correct side of it before the crowd arrives. Now let me give you the operating system. First, identify the layer. Is this a temporary forced sale discount, term structural shift, or an innovation wave? Second, size differently by layer. Temporary dislocations require patience and toughness. Structural substitutions require macro monitoring. Innovation waves require humility because the failure rate is higher. Third, follow the money. Institutional flow matters more than public explanation. Fourth, do not confuse discomfort with invalidation. The most attractive setups usually feel wrong before they feel brilliant. Fifth, separate long-term thesis from short-term path. Gold can be structurally strong and temporarily weak at the same time. Biotech can be structurally attractive and individually dangerous at the same time. Coal can be economically compelling and socially unfashionable at the same time. Sixth, respect risk. Higher upside sectors do not deserve unlimited sizing simply because the story is good. Seventh, act before the narrative cleans itself up. Once the explanation is comfortable, the edge is usually smaller. That is the heart of it. The real opportunity before retirement is not one magical asset. It is the ability to recognize overlapping layers of opportunity while everyone else is still waiting for one simple story they can understand emotionally. That is why this kind of setup can define a decade. Not because every idea works, because the framework lets you see what most people cannot see until later. Now let me end where this really matters. You can keep waiting for one clean signal. You can keep treating every opportunity as though it must arrive neatly labeled and socially approved. You can keep asking which one stock is the play and ignore the deeper forces shaping where money is flowing. Or you can do the harder thing. You can learn to read the layers. You can see the temporary dislocation in gold and silver. You can see the structural energy substitution pushing capital into coal. You can see the innovation and MA wave building under biotech. And you can build a portfolio that benefits from different kinds of edge instead of depending on one emotional narrative. That is the threshold. Because the final major wealth window before retirement will not ring a bell. It will look messy. It will feel uncomfortable. It will arrive while the public is still confused. That is the mirror. Look into it carefully. If you keep waiting for the perfect story, you may miss the perfect setup. And the people who act now will not seem brilliant at first. They will simply understand layers. Later, everyone else will call it obvious. It was never obvious. It was structured.